All right. So yeah, some of you folks are trickling in. Kind of a light audience today. I kind of forgot that you all are off work, so to speak, right, in higher education. So I could have done this earlier in the day, but this is later in the day, 4 o'clock Central, Wednesday afternoon, early evening. So see a few of you trickling in. There's been a big demand for the recording, so a light audience today, which is fine. Housekeeping here. If you have questions, go ahead and I've done this a number. I'm not an expert at this, but throw it down in the chat or the Q&A, one of those. I'll get it. Either one, I'll get it. I'll either answer during the presentation or afterwards at the end, probably at the end. Or email me. I'll give you my email, of course. So today, now, before I begin, you wouldn't believe how many times this happens. If you're not in higher education, you're not going to get anything out of this. So those folks that are watching, listening to this recording or live, it certainly help if you're in higher education. Okay, you'll get the most out of this. So we're going to talk about the Roth 403B. I'm going to go ahead and share my screen to get us going here. Okay, and so for those of you, as I get organized here, so for those of you that don't know me, there we go. And if you can't see my screen or something looks wrong, please, by all means, somebody tell me, okay? Okay, so for those of you that don't know me, my name is Greg Shepard. Some of you have gotten my emails, sent videos out. Some of you have been on these webinars before. Again, name is Greg Shepard. I have an investment management / financial planning firm here in the Kansas City area. We're supposed to get feet of snow tomorrow. So hopefully where you are, usually I'm dealing with folks in the Midwest, but just got back from Arizona. Heck, it was colder down there than it was here when I was down there. I'm here in the Kansas City area, but I help folks, specialize in helping folks just like yourself all over the country that's in higher education, navigate and get the most out of their retirement plan. As you can tell, I've said that tagline a few times before. So I deal with folks just like yourself in higher education. Now, today, we're going to spend, I got 7 slides here, 30 minutes-ish, depending upon questions and how many tangents I go on. I'm going to talk about one feature of your retirement plan, arguably the most overlooked, how do I say this? The most overlooked, underutilized feature of your retirement plan. The other feature, I think, is as advantageous, maybe not as advantageous, but I think equally important, is brokerage link. Especially folks up there in Nebraska. I get a lot of folks, for whatever reason, on these webinars from Nebraska. You all just enhanced your retirement plan where you have that brokerage link feature on your 401a. It's very advantageous to you. So if you don't know what that is, please, by all means, I'm jumping ahead of myself. Check out my website here in this podcast, okay? Higher Ed Retire. I go into I think I have 34 episodes on there. All kinds of information that is advantageous to you and your situation with your retirement plan at the university. It doesn't matter which university you're at. And of course, like I mentioned before, contact me if you have questions on this or any other topic of your retirement plan. Here's my email, of course. I put my phone number there, but I can't literally recall anyone ever calling me. I get a lot of email, of course, with technology these days. So let's go and get going here. 403B, the Roth 403B. Now, this is a feature in your retirement plan. I don't know everybody that's on this call today. I see Nebraska, Missouri, Arizona. Some of these are just like Yahoo, Gmail accounts. So I don't know where you are. But every institution I just mentioned, you do have the feature. I get some from Kansas Board of Regents. Gosh, I can't recall at the top of my head now. You may. Gosh, I can't recall. So I apologize about that. It takes me 10 seconds to figure it out. Most of you out there will have the Roth 403B, most likely in your voluntary account. Okay, so now a 401A. That's going to be a mandatory account. If you look at your 401A, you're going to have contributions from the employer and employee. Your 403B, 457, that's your voluntary. That's where you're putting money in. The employer is not. Okay, Roth 403B is notorious for the 403B and 457, but a lot of institutions have instilled it inside the 401A. So we're going to get into some reasons as to why you should consider the Roth 403B. Doesn't matter how old you are now. Of course, the younger you are, the more advantageous excuse me, the more advantageous this feature is because you have the power of time on your hands, which will make more sense as we get into this. But even if you're closer to retirement, there could be some advantages of this feature. So here are 3 reasons. I'm just going to read this verbatim, and I might go off on tangents here and there. But again, if you have any questions along the way, by all means, throw it in the chat or the Q&A. Number 1, tax-free income. Now, before I begin, most of you may be familiar with a Roth IRA. I don't have this information in here, I don't think. A Roth IRA, if you're over 50 years old, there's a limit on the contribution amount you can put into your Roth IRA, $7,000, okay, for a lot of you out there. The contribution limits to a Roth IRA are curbed by what the max contribution limit is for the Roth for the 403B period, okay, which is like 3 times, 4 times as much as what you can put in to a Roth IRA. So why is this important? A lot of you out there, okay. Now, I don't want to go off on too many tangents here, but there's some strategizing that goes into play here. So let's take one for example. Let's see here. I've got some doctors, okay, in the med schools, Nebraska, Missouri. Incomes are quite high, and there's an income phase-out limit as to how much you can or can't put into a Roth IRA. If you make too much money, you can't put into a Roth IRA. However, if your institution has a Roth 403B, there is no income limits. Okay, so if you're making $300,000, $400,000, $600,000, I see this predominantly more so in the hospitals, med faculty. There is no limits, income limits. You can put into that Roth 403B. So that's very advantageous for you high income earners out there. All right. Okay, let's just dive into this. So what is a Roth 403B? I'm going to go over some specs, I guess you can call it, of the Roth 403B. And like I said, as I've already done, I'll go off on tangents as we go along, barring any questions. Okay, tax-free income. In the event, I'm just reading verbatim right here. Okay, in the event of either retirement or termination, your earnings can be withdrawn tax-free as long as it has been 5 years since your first Roth 403B contribution and you're at least 59 and a half years old. So think about that. Let's put it on the back burner here. So tax-free income at retirement. Sounds good, right? Okay, tax diversification, number 2. Of course, you've heard of diversifying your portfolio. This is a different webinar, different topic, diversifying your investments. Why wouldn't you want to diversify your tax situation too, right? I'm in the business, okay? The reason I say that is I want money. So I'm 46 years old, so I got a ways to go. Now, this kind of goes into number 1 and number 2 here, tax-free income and tax diversification. I'm 46 years old. I'll be working for what? Another 20 years at least. Some of you are trickling in, that's fine. I got another 20 years-ish of working. Why wouldn't I have no idea. You have no idea. Nobody out there has any idea what the income tax brackets are going to be when you retire. Doesn't matter if it's next year, 3 years, 5 years, 20 years, like myself. Why wouldn't you want to have 2 buckets of money to choose from for distribution purposes when you retire? One pre-tax, okay, that's your what I call the normal 403B. When that money comes out, it's taxed at your ordinary income tax bracket, okay? And of course, the Roth, like I just mentioned, that comes out tax-free. Now, the counter to this is that when you're putting money in, let's see, am I getting ahead of myself? Give me just a second here. Yeah, okay, so I'm getting ahead of myself. I think it's the next slide. All right, so let me curb what I was going to talk about until maybe the next slide or so. So again, tax-free income, distributions from a Roth 403B at retirement, awesome, awesome, awesome. And you accomplish tax diversification because the unknown is down the road when it comes to taxes. Now, I left number 3 on here, tax-free to heirs. Let me explain this. I created, I've done a lot of talking today, so I apologize. So I created this presentation maybe a year, not that long ago. It was beginning of this year. And the rules around inheriting IRAs have changed twice since I've done this. So, little side note here, if you have inherited an IRA from usually a parent or grandparent of sorts or anybody, make sure you know the rules on distributing those assets, okay? Because it's changed and it actually caught me. I'm in the business and it caught me up. So what it says here, the third reason why you consider Roth 403Bs, it's a great estate planning tool for beneficiary. It used to be greater, okay? It's still good. What I mean by that though, is when you put into the Roth 403B, okay, you retire, either becomes a Roth IRA at that point, or you keep it as a Roth 403B. Doesn't matter. You die, you pass away, you transition those accounts to, most likely, if you have children, they're going to go to your children. All right, that's common practice. Those children, as it states today, they reap the benefits of a Roth IRA. Okay, where what I mean by that is their distribution. Let's say you have $50,000, $60,000 in this account and you pass away. So Joe, your son, inherits this account. Well, Joe, according to the IRS rules now, does have to take an RMD, even if Joe is 20, 30 years old, 40, doesn't matter. They have to take required minimum distributions from that account, tax-free. Okay, I can't emphasize that enough, tax-free. Okay. And like I said, if just throw in some questions in the chat or Q&A if you have questions. Okay, so as I mentioned earlier, well, if I did, I've been doing this for over 20 years. You know, Roth IRAs have been around a long time. Roth 403Bs are a little newer, but still been around for a while. Let me just read this verbatim rather than kind of going off tangents here. So the one pushback I get with Roth 403Bs, if I have, 10 financial gurus in here, CPAs, you might get a few different answers as to what they think financially the right strategy is. I'm going to give you my 2 cents here in just a bit. So let me just read this verbatim in bold there. Will you be in a higher marginal tax rate in retirement than I will be during my working years? Okay, let's just move on here. This is a question that nobody can answer with certainty because we really don't know what the taxable income brackets are going to be once you retire. Now, in theory, your income is going to go down, right? When you retire, you have no paycheck. Now, I deal a lot with folks that when they do retire, yes, their income goes down. Now, some of you may have pensions out there, okay? The old pension system, like Missouri, you have your old pension system. Now, you've transitioned over to 401A with newer employees, but there's still those pensions that are around, legacy accounts. Pensions, in Kansas, we have Capers, there's Mosers over in Missouri, if you're below higher education, Social Security, of course, and then you're taking income from your retirement accounts. Ideally, you want 70, now everyone's different, but you want 70, 80% of your income being produced by these different buckets of money. If you're familiar with, I doubt a lot of you are, you'd be a little tax geek like me. There are income brackets. Now, what I'm getting at is that just because you retire, let's say you're making $100,000. Well, ideally, you're going to try to take home $80,000 from all these sources of income, right? All of your money isn't taxed at this higher income bracket. What I'm getting at is that even though your dollars that you're receiving go down, your tax liability isn't necessarily going to drop dramatically, okay? I don't want to get into the weeds in that. If you have questions around that, I'd be more than happy to expand on that and bore you to death about it. So let's just move on here. So if tax rates were to decline, when you retire, a traditional pre-tax, that's what everybody has now, most folks, a traditional pre-tax 403B might be the better option if tax rates were to decline. The same is true for individuals who expect their marginal tax rate to be lower in retirement as a result of lower income. Okay, wrap your arms around that for just a second. Generally speaking, if tax rates rise, okay, in the future, paying taxes now through a Roth 403b will likely yield a higher after-tax retirement benefit than a traditional pre-tax 403b. By the way, there's going to be a visual next slide. So if this is kind of a little wonky for you, hang tight. If tax rates decrease, okay, which actually just occurred, all right, starting next year, maybe, income tax brackets change a little bit. Deferring taxes now in a traditional pre-tax, the normal 403b will likely benefit you more at retirement. Okay, let me show you. Rather than verbally telling you. Okay, take a look at this. We're going to keep it very, very simple, all right? And there's calculators out there on Google that can help you with this as well. So I get this question all the time. Two-part, should I start a 403b? You know, maybe you're 60 plus years old. Should I start a 403b? The answer probably is yes, okay, for various reasons. And then how much should I put into a 403b? All right. Now, I'll tell you this. Again, I've been doing this a long time. I try to put away as much as I can into that post-tax, that Roth account, because well, I don't want to get ahead of myself. Yeah, okay, I'll table that. I'll tell you why here in just a bit, okay? Let's look at this example. Contributions to Roth 403b is that first column. And then, of course, the normal, what most of you all have out there, what I call normal 403b is on the right side here. So pre-tax contributions. Okay, that's what most people do now. We put 6,000. Your salary is 30,000. Most of you out there are making more than that. We're just trying to keep this very simple. Pre-tax contributions, 6,000 to the normal 403b. Taxable income. Okay, when you put your money, I think most people understand that when you put it in pre-tax, your taxable income 30 minus 6 is 24. So your taxable income now becomes 24,000. It's still 30,000 if you're putting into the Roth 403b because the money's going in after tax. Right here, Fed taxes paid annually, 7,500. Okay, 6,000 right here. Okay, there's some variables here. Fed taxes paid annually. Oh, I just did that. Post. Okay, here's the Roth contribution, 6,000. Obviously 0 here because we're putting it in the normal 403b. Your take-home pay after taxes. It's a little depressing, isn't it? So your normal 403b, it's going to yield a higher take-home pay. Okay. Now check this out. Total retirement savings after 30 years. Here's some variables down here. 474, 349, because you're putting in the same amount. The dollars that you're putting in doesn't necessarily change. Here's where it changes. Fed taxes owed at withdrawal. Okay. So 0 for that Roth account, 71,000 for the traditional, the normal, you know, what everyone else is doing here. Here's the big one, take-home retirement savings, 474 versus 403 after 30 years. And that's kind of summarized here in the next slide. I want to make sure you don't have to necessarily grasp all these numbers. Let me state, I'll tell you this. Okay, I'll tell you right now I'll tell you right now. So again, I've been in the business a long time. I try to, and I don't mind telling you, I don't have a retirement. I own my business, right? So I don't have an employer retirement plan. I make too much money to put into a traditional IRA. So what I do is I put my money, into a Roth IRA. So I'll put my money into a SEP IRA, but every year I talk to my accountant and I see what makes sense to put into that Roth conversion or convert money to a Roth IRA every year. Okay. I want to sock away as much as I can intelligently into that Roth feature, because when I retire, I have no idea. Again, I'm 46. I have no idea what the income tax brackets are going to be. I don't know how these things are going to change. I want two buckets of money to choose from at retirement. Okay. For kind of I don't know what you want to call it, a safety net or to strategize, if you will. So let's go back to this here. Okay. In this situation, the individual who contributed, and I'll read this slowly, the individual who contributed to a traditional pre-tax, which is what everyone out there is doing for the most part, save $45,000 in taxes over 30 years. Let me talk about that real quick. So yes, you'll save money on taxes in your earning years, when you contribute to that traditional normal 403B. Now, I always tell folks, and this may not be the right financial thing to say, but let's say you're sitting where you are or on the beach, wherever, when you're 70 years old, whatever the age is, you're retired. Are you really going to care that during your high earning years, you saved $45,000 over 3 decades when you're sitting on that beach, taking money tax-free from your accounts? I'm not, because I'm in my earning years, I'm making money. I might pay a little bit more in taxes with the Roth contribution, but I tell you what, man, when I'm taking money out, I want that tax-free, okay? Let's move on. And if I'm going too fast or you need some clarification, just let me know. However, at retirement, check number 2 here. However, at retirement, this individual will owe $71,000 taxes on their retirement. So the individual contributed, saved $45,000, okay, but they're going to owe $71,000 upon the retirement when that money comes out. So we can do the math here. Over a lifetime, the individual contributed to a Roth account will have paid $26,000 less in taxes and will have a smaller tax obligation in retirement. Okay, that is why you want a Roth. One of the reasons why you want a Roth 403B, you want to take advantage of it. Okay. Like I said earlier, a small crowd because of the time of year. I forgot you were out for break. So there's been a lot of demand for the recording. Usually I get a few questions, but so far so good. We're rolling through this. So I'm assuming everyone out there is understanding this. Now, depending upon where you are, whatever institution you are at, I deal with so many of them, like Nebraska, they're actually going through some wrinkles. They're trying to figure things out. We're having a few problems, not problems. It's just taking, everyone's wanting to change their retirement plan at the same time. So it's taking Fidelity with Nebraska a little longer. So what do you do from here? How do you implement this? Okay, first you need to think about if you want a Roth 403B. Roth 457, remember, it doesn't have to be a 403B. Does it have to be a 457? The 401A, if you have a 401A, I can't recall, usually very rare do you see a Roth feature with a 401A. Man, I can't remember. I've dealt with it in some institutions that there is, but I know for a fact, if your institution allows the Roth feature, it's going to be in your 403B 457 for sure. And by the way, real quick snippet on 403B 457. I do advocate, listen to some podcasts here, episodes where I talk about the difference between that 403B and 457. But typically, I'm going to have clients put money into the 403B. If they max out, okay, whatever your age is and the max out, then we spill over the extra contributions into the 457. And there are a lot of institutions, there are different investments available in each account, okay? Keep that in mind. So I like the 403B first before the 457. And the 401A, if you have a 401A, that's mandatory. You don't have a choice. All right, going back to here. All right, looks like we're doing okay on questions. What do you do from here? Well, first find out if your institution does have a 403B. You can find that out on your website. It's very, very simple. Or just call, usually it's Fidelity or TIAA. There's the main, the big boys in this space. So you could do it yourself. Call Fidelity, like I say right here, or TIAA. You have your contributions directed towards Roth account. Okay, they can do that. So one question I get is, can I split up my monies? The answer is yes. You can do 50-50. You can do 100%. Like I said earlier, you can do 100% of your contributions, your deposits, into a Roth 403B or 57, if you so choose. You just need to call Fidelity or TIAA. HR is not going to be able to help you. Call typically, because Fidelity and TIAA are taking your deposits, so they can distribute those assets accordingly. And I'm telling you, what you need to do, look into where it really becomes fun is in the Roth 403B or 457. Do those accounts have brokerage link features? I can't stress this enough. Go to this website, and check out, or on your Apple, what is it, iTunes or whatever, just type this in. There's an episode on brokerage link if you don't know what that is. I have 100% of my clients, and I have hundreds, well, a couple hundred in higher ed. If they have brokerage link, they're in it. Okay. So one is do DIY, do it yourself, or of course you can have me help you out. All right. I'm not going to harp too much on that. So again, I've been doing this for over 20 years. I know your plan actually probably better than Fidelity and TIAA reps themselves. And what I've always done in the past is not everyone that contacts me becomes a client. So I can throw your portfolio into some software I have, and you can kind of see what it looks like. And then I do a hypothetical. Well, this is what it would look like if you had brokerage link, and do what I've done for your colleagues. Okay. And you can make a business decision and go for that. I do not work for free. I get that question all the time on these webinars. My fee is always asked. My fee to do it for you folks out there, 1% per year of the assets that I manage. 1%. That's the most I charge. Let me rephrase. That's the most I charge. As your assets get larger, my fee goes down. As you go on into your career, okay, if you're younger, it doesn't matter. I have webinars on these 4 topics going forward. The reason I've chosen these topics is that, as I said earlier, these topics are the most overlooked, underutilized things or strategies in your retirement plan. Roth 403B, we're talking about. Brokerage link, I spoke about. Rollover forth. A lot of you that are employed, if you're over 59.5 and I can think of one institution right now, if you're over 59.5, still employed, you can do an in-service transfer of your voluntary monies over to an IRA. In my case, my clients use Schwab. You can use Vanguard, Fidelity, wherever you want to go, but you can do an in-service transfer of that money if your retirement plan isn't that good. Take that money out, put it over in a rollover IRA, continue your contributions to your 403B through payroll in your university. And of course, I get a lot of questions on 403B versus 457. I try to do this once a month. 30 minutes is usually, yep, here we are, 30 minutes. I'm gonna leave it open for 20, 30 seconds. I can't think of much else to talk about. Anything else, you folks out there? Trying to think of other questions I get a lot. That's about it. Oh, one question I do get is Fidelity and TIAA, like I said, are the big boys in your space. Most institutions I've seen do offer Roth 403Bs through both vendors. I am a big advocate. I don't have a dog in the fight. Okay, I don't work for either Fidelity or TIAA. I do not work for your university. I work for S&A Financial Services, which is my company. Okay, my firm. The reason I say that is I custody or hold on my clients' assets if I can over at Fidelity. I get nothing from them, okay, compared to TIAA. I do like TIAA. They have 2 investments that I like. I'm not going to say that right now, just for, I don't want you all to go out and buy the investments I talk about. You can also do combo. Okay, I'm getting off tangent here, but I have a lot of clients where we do combo. We utilize TIAA and Fidelity for very specific reason that I'll elaborate on. Actually, I might add that to a future webinar. Best of both worlds, okay, Fidelity and TIAA. I'll do that later on, but best of both worlds. Okay, cool. I've talked fast enough. 4:30 Central here. I don't think there's any questions. So folks, okay, keep your eye open for January sometime. I'll do another webinar. Greg Shepard here, S&A Financial Services. Hope you all contact me on any questions, right where my contact information is, and right here. And I'll send out the recording too. All right, folks, take care. Have a good holiday. Bye-bye.